Victoria, we just talked about Texas and oil rigs. It's amazing. Every data point is negative. Oil, job market, et cetera, et cetera. All we've got is stimulus. Stock market doesn't seem to care. It's all about the Fed, right?
Yeah, and it's something that you have to look at it that it's not about good or bad, it's about better or worse. And so the stock market keeps pricing in that things might genuinely get better. I mean, rig counts, as you quoted in your random but interesting, are down. I think it was 294 total across North America. That's a 74% drop from where it was only 6 months ago, much worse than it even was in 2016. So you're definitely seeing some pain in the oil patch. But the markets right now, they're thinking that the Fed and the government's going to come in, they're going to have this almost invisible hand and give us all of this money and easing, and they're pricing in that it's going to get better. So stocks keep rising, which has been a surprise to all of us.
Well, let me ask you this, Victoria, since you are in Texas. I mean, if energy can, I know it's what, 4.5%, 5% of the overall market. It's tiny. I get it. But if oil or energy and the financials can start really participating, what could happen to this market?
Well, I think you'd see more of a rotation from growth to value, and we've seen shades of that a little bit the last few weeks where we might have a sector rotation, and you got to be wary about your tech allocations right now. I mean, those big five, they're what, 23% of the S&P 500 now, and if you actually take them out of the S&P 500, those other 495 stocks are actually negative on the year. So if you actually had them start to participate more with financials and energy, you would see a definite improvement in value stocks and definite improvement in dividend stocks and an overall improvement in different sectors of the market and different breadth. You know, it's something that the Dow is still down on the year where the S&P is up 4, and that growth value divide is about as wide as we've ever seen it. So that's something we are definitely cautioning our clients about right now.
All right, quickly, where are you and your team at G Squared finding value? Leave us with a Friday opportunity, Victoria.
Yeah, absolutely. So one of the places we love, and I know it's a name not a lot of people love, but it's IBM. It's big, old, and ugly. Big Blue, though, has a massive footprint in the tech market. It's a tech name, a 5% dividend yield. Man, it kicked off $3 billion in free cash flow second quarter. There's a lot to love about this stock. It's a turnaround story with the new CEO. We think that's definitely a stock you can look at in a tech sector where we're going to see enhanced spending, but it has a much lower valuation. It's only about 10.25 times PE, much better than a lot of the valuations you see on Microsoft or Amazon. We also like the tower REITs, right, Brian? You know, CCI, AMT, they've got decent dividend yields. They've recently pulled back a little bit, but you know, data usage has doubled almost every 2 years for the past decade. And I don't know about you, I'm spending more time on my cell phone than I ever have. So as this 5G rolls out, you're going to see continued revenues, and they're very COVID-safe names.